The United States, in a move sending shockwaves through the global economy, has imposed sweeping tariffs on a vast array of imports. These tariffs, impacting goods from China, the European Union, and even close allies like Canada and Mexico, mark a significant shift in U.S. trade policy. This protectionist turn, while touted by the administration as a means to protect domestic industries, has ignited fears of a global trade war with far-reaching consequences. The tariffs, covering sectors ranging from steel and aluminum to automobiles and electronics, represent a substantial escalation in trade tensions. The administration argues that these measures are necessary to address unfair trade practices and protect American jobs. Critics, however, counter that such actions are likely to harm both the U.S. economy and global trade, leading to higher prices for consumers and retaliation from trading partners. The economic consequences of these tariffs are already being felt across the United States. Economists warn of a slowdown in GDP growth, with projections estimating a reduction of at least half a percentage point in 2025 alone. Inflation, already a concern for American households, is expected to rise further as the cost of imported goods climbs. This perfect storm of slowing growth and rising prices threatens to undermine the economic security of working-class Americans, the very group the tariffs were ostensibly designed to protect. The stock market, a barometer of investor confidence, has reacted negatively to the escalating trade tensions. The S&P 500 has tumbled nearly 7%, while the tech-heavy Nasdaq 100 has entered bear market territory, signaling growing uncertainty and fear among investors. These market declines reflect concerns about the impact of tariffs on corporate profits as businesses face higher input costs and disrupted supply chains. The impact of these tariffs extends far beyond U.S. borders, sending ripples of uncertainty and anxiety throughout the global economy. The International Monetary Fund, a key institution for global financial stability, has issued stark warnings about the potential for a synchronized global slowdown. Their analysis suggests that a full-blown trade war, with escalating tariffs and retaliation, could shave off as much as half a percentage point from global GDP growth. Stock markets around the world have plunged in response to the escalating trade tensions. The FTSE 100, a benchmark index for the London Stock Exchange, experienced its sharpest single-day drop since the depths of the COVID-19 pandemic, a stark illustration of the interconnectedness of the global economy and the widespread fear triggered by the specter of a trade war. China, the European Union, and other major economies have all announced retaliatory tariffs, setting the stage for a tit-for-tat escalation that could inflict significant damage on the global trading system. The long-term implications of this protectionist turn are far-reaching and potentially devastating. The tariffs, if maintained and expanded, threaten to unravel decades of progress toward a more open and integrated global economy. This shift toward protectionism, driven by a dangerous combination of economic nationalism and political expediency, risks undermining the rules-based trading system that has underpinned global prosperity for generations. The consequences of this retreat from globalization are likely to be severe. Consumers around the world will face higher prices for a wide range of goods, eroding purchasing power and potentially stifling economic growth. Supply chains, carefully constructed over decades to optimize efficiency and reduce costs, are being disrupted, forcing businesses to scramble for alternative suppliers and navigate a more uncertain and volatile global marketplace.